Welcome to the Dividend Talk podcast, episode 169. Third quarter earnings, but what about Sanofi? Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. See you on the inside. Hey, European DJI. More earnings and lots of questions today. It's going to be a busy episode.
Hallelujah. Yeah. And unfortunately, already for some of the listeners, we can't address all the questions today. We got so many questions about stock tickers, and we're not Jim Cramer, right? We're not a walking encyclopedia. So we often need to look a little bit up, and we also take our listeners serious. So we don't just want to answer something without or by only looking at the headlines. But oh my God, on Facebook, in our Facebook group at Dividend Talk, and if people are not part of it, please join us. But we got such a nice poem from Gordon, and it was really an ode of love to the Dividend Talk podcast, and I just have to read it. May I?
Yes, I think you should.
Okay, let's go. Two European fellas with a shared passion. Cash flow never goes out of fashion. Looking for freedom or a fat fire? Here you find everything a dividend heart desires. Deep dive analysis next to shooting the breeze, carried out with humor and ease. Jokes about bankers and litigation dissection, hidden gems and honest reflection. There's talk of shower curtains and talk of cash flow. There's even vodka drinking live on the show. From work-life balance to balance sheets, on parenting, discipline and earnings beats. Aristocrat or king, there's nothing sacrilegious. So watch out, Nestle, although you're prodigious. Silly innuendos and abusing CEOs. Strap on, stinky, here everything goes. Never sell shell, watch out for adjusted. Adjusted is sometimes one step from busted. Yes, I'm looking at you, ABM. And don't go hiding, Bayer or 3M. Innovation, disruption, or your everyday sin. With dividends, there are many ways to win. So stick to dividends, girls and boys. Don't go astray looking for other toys. Though the road we've chosen is steady and slow, you too shorten the road for the average Joe. 168 times you've recorded. 168 times I've been rewarded. You're my consumer staple on my Sunday run. You make sure that the waiting is fun. To these two gentlemen, their praises I sing. May their cups of dividends be filled to the brim.
Wow.
From Gordon.
Wow. Honestly, I think that was amazing. It actually sums up Dividend Talk like in a nutshell, doesn't it? I was speechless. I'm beyond words with that.
But yeah, okay. We still have a whole show to do. Fully packed, but these love letters, keep them coming. I love fan mail. Thank you. And to just show a token of appreciation back then, because I'm a owner of AbbVie, and Gordon, I hope you too, because we decided today to hike the dividend by 4.7% to 1.55 quarterly. So I hope you own AbbVie, and I really, really hope you really appreciate this token of appreciation back from us as shareholders. And the next one, of course, is Visa. I don't own Visa, but oh my God, they hiked their dividend by 15.6% to 52 cents quarterly. It's amazing, right? And for me, this is the example of a high growth, low dividend stock that if you bought it 10 years ago, you will be almost now on the yield of horizon, but you will be bypassing it in this fast Ferrari in the next 2-3 years. And a nice demonstration of why we should have a mix in our portfolio and not only the high yields.
Yeah, I think Visa demonstrate what a real moat is, doesn't it? I mean, its growth has been fantastic, and I always think back to one of the first interactions I've ever had with Dividend Wave. I used to post all the charts, and remember he posted one of slow growth. What was it? Low dividend yield and high growth, and high dividend yield and low growth, and seeing that chart bypass. It's always every time I see Visa, it brings me back to that. But it's a company that I wish I owned 15 years ago. Honestly, it's just one of those companies that always seems overvalued for a reason. It's a premium company. It's one of these tier one companies we always would talk about. It's just the yield is so low, and you'd be thinking yourself now, can they continue this growth 10 years into the future? But by the looks of it, there's no stopping them.
Yeah, I mean, I wish I bought it one time and I didn't. It is like it is, right?
It is what it is, exactly. I remember when I was doing my option trade, and I had picked between Visa and Alibaba, and I chose the wrong one, and ended up losing a lot of money on Baba. Instead, I could have went with Visa and made a lot of money. So, yeah, decisions, but yeah, it's top quality company. But hey, let's look at some of the news of the week, and I don't think there's any escaping the Sanofi share price drop. I think we've been asked a couple of questions by Hugo and also Adela. What is going on with their share price? Why have they dropped? What is actually happening with this company? I think everybody's a little bit spooked at the moment.
Well, really simple. Let's start talking about the first thing. And there is something really interesting with Sanofi, of course, their partnership with Regeneron. So that has been, of course, lifting up the sales from Sanofi. But then if you now look at the third quarter 2023 compared to the quarter last year, their sales declined by $500 million. Yeah, so while their IFRS earnings went up to €2 per share, which is a good thing. It's a bit interesting, of course, that they had a small earnings drop. But I think the big news here is simply said that generally the pundits, they think that Sanofi doesn't have the ability to generate a proper return on investment on their R&D. They have not proven this in the past, and it's true. Sanofi was simply dead money until they won the jackpot for Regeneron. There was not a lot of innovation coming out of Sanofi. It was just an awesome deal they were able to make, right? So if they then now want to spend more on their pipeline because they find themselves that their pipeline is too weak, yeah, I mean, that's the issue, right? Because so far there's no evidence that they have the best scientists in the world that can turn an idea into an actual product here.
Yeah, I mean that's essentially what they're saying, isn't it? That Sanofi have a pretty poor pipeline coming through. The overall industry is looking at a 200 billion worth of patents expiring over the next couple of years, and there's lots of panic now. Who's going to come up with the next blockbuster drug? And you're looking at Sanofi's R&D department, and you have to think, compared to their peers, they have been underperforming over the last 10 years. I think their average return was 6% compared to the average of 10%. And obviously with averages, there's companies that were probably doing double that or more than that as well. So it doesn't look too good for Sanofi, particularly when you're going chasing for the next blockbuster drug. Having to chase it like that when you're under pressure is quite difficult, I would imagine.
Yeah, definitely. And I have been looking at Sanofi over the last 4 years so often. It was really just that money all the time until this Regeneron. So I totally understand the market narrative. Actually, I found that Sanofi went way too far up. Also, even if you look at Sanofi, their dividends, right, over the last years, they were not growing a lot, like 2-3%, until then they had this cash flow windfall. Yeah, that's really what changed for them. But until then, it was like flat money. So, and we saw that in the dividends as well. So only last year it made a decent hike.
Yeah.
And we want to see more. Simple as that.
It looks like they're also spinning off their consumer health segment as well.
Yeah.
Which probably makes sense for them. I think that generates, I don't know.
Yeah, and this is interesting, right? Because GSK did it.
Yeah.
Johnson & Johnson did it. It's really something from the last 2-3 years that all these conglomerates are spinning off their consumer business. And I really sometimes wonder why, because I think they're just desperate to create shareholder value. But from the other side, it's not too bad to have a bit of a cushion for bad times with the consumer health division.
Yeah, but maybe management just want to focus on what they're good at. Maybe consumer health is just not where their expertise are.
Will management then go with consumer health, because seemingly they're also not too good at creating a proper pipeline?
Maybe the scientists might go to consumer health as well.
Yeah, they spin it off and they spin themselves with it off, and then.
But it's always interesting when I read companies when they say stuff like they expect next year to have low single-digit growth rates compared to this year, and will rebound in 2025. What that says to me really is there's no rush in investing in these guys. We're going to have 4 more quarters of poor performance, which is going to drive their share price lower, or at least not higher anyway. So there's plenty of time to sit back and assess these guys. But it's
But last year last September you could still get the shares in the mid 70s somewhere, right? 70, 80.
Yeah.
So what we're talking about now, I mean, I'm not saying that it will go back there, but for me, let's be honest, for me, if I knew before that Sanofi would make this big deal with Regeneron, I would have bought it. But of course, nobody knows, because these things are announced and then you're always too late. But for the Sanofi, excluding Regeneron, I don't want to own the stock. There are much better pharma companies out there. It is as simple as that. So I don't care that it dropped with 15%. I'm not going to look in it anyway. I rather spend my time now on studying a little bit more onto Bristol Myers, which is now around $50. Which I remember from the past, I find a relatively interesting stock. If people are generally interested in, in owning a pharma stock, go to my video from February this year or something like that on YouTube. I will try to put the link in the description here, because I compared the top 10 big pharma companies of the world. I showed there also how much of their revenue, how much percentage of their revenue is depending on the top 3 sales. And this is always a nice view of looking at things, because if the top 3 is the majority of the revenue, you have a lot of single patent risk, right? But if it's like 20-30% of the entire revenue, you're talking about a well-diversified big pharma company. And I think these things are really important to take into consideration. I would then, if you're interested in that, have a look at that. There's a G sheet with it where you see all the pharma stocks. It is from February this year, but those companies don't change within 1 year significantly. So I think the general outcome is still relevant for if you want to form an opinion.
Yeah, interesting. All right, isn't it? It'll be interesting to see what happens to their dividend if they continue under pressure, and what will happen with the spin-off as well. I'm sure we'll find out soon. But yeah, I'm not in a rush for Sanofi. There's definitely better options out there, in my opinion. So, the main topic, we have quite some earnings to get through, maybe 4 or 5. So we might just dive straight in there. And one of the companies was suggested by 2 people on Twitter or Facebook, Hands and Financial, and that is T. Rowe Price, ticker symbol TROW. I don't think anyone will be surprised if you look at their share price. They've been under pressure pretty much all year long, and nothing has changed. It's pretty much the same as last quarter. The revenues are under pressure. Their management fees are under pressure because they have to exit some of the higher fee kind of, like your shares. They have to move into ETFs, which charge lower fees. So that's all contributing into them actually performing worse year over year. What is also interesting is that their AUM is falling. And again, that's because they're having net outflows of around 17 billion instead of net inflows. So there's money leaving them consistently this year. So it's 17 billion this quarter, and over the 9 months, it's up around 20, about double that, I think. So look, it's been a tough quarter. The CEO comments on that himself. He's basically said in a nutshell, look, we're doing our best here. We're trying to save costs wherever we can. We're moving into lower fee structures, but it is a tough quarter, and they continue to see that for the remainder of the year as well. So I think we're going to see another quarter of this as well, I have to say. Their AUM dropped from 1.6 in 2021 to which is now 1.3. So they're hovering at around 2019 levels in terms of AUM.
So this sounds quite scary if I hear you talking, but let's put it in perspective.
Yes.
2021 was the year that everyone was betting on Katie Woods, crypto to the moon, Wall Street bets. The stock market had so much cash coming in because also of all these $1,000 checks that the American government was giving. So that is a year that was really special. It dropped then in 2022, and we know that in 2022, late last year, there was also quite a stock market decline, and we are experiencing a similar period right now, similar emotions. But compared to that, the assets under management are actually a little bit higher than it was at the end of 2022. So that's important to know, I think. If we look at generally at the earnings, they now have a diluted earnings per share of 197 compared to the same quarter last year of 166. That's also better. I believe that the dividend is 148 or something like that. I believe something like that. I'm doing this out of my head. I'm not watching at any screen, so I might be wrong here. Yeah, or 112 or 1. But what I'm trying to say is, like, I know that this dividend is nicely covered. Also, they have a pristine balance sheet, no debt. So, if this is the stock market decline that we are experiencing with the cash outflows because of high inflation, people are probably going more into bonds. If this is it, this company is totally prepared for this. Yeah. So I know there's a question later on, like which stock are you a bit worried about in your portfolio? Well, I don't like, of course, to see TROW price now trading at 19 because it feels like a paper loss. But to be fair, this week, the day before earnings or 2 days before earnings, I was not paying attention to when they were paying earnings. I bought 5, 6 shares or 7 shares again because I felt like, okay, it's already a relatively big position, but why? I don't want to watch in the mirror in a year from now and think like, how stupid that I didn't make the opportunity sub 100 to buy a few more shares. That was my thinking. So while I'm not going big into it because I have my rules, I mean, I really wanted to use this opportunity. So from one side, yes, it all sounds scary here, but if you purely look at the facts and if you know that this company has set itself up with their balance sheet to protect themselves against these times, and it is also a dividend aristocrat with a very safe dividend profile, then yeah, I just want to give a little bit of a sounding voice as well, because it's so easy to fall into this trap of the stock market. Every day it's red.
Yeah, no, I agree with you. Like if you look at, let's just take assets under management, because we use that as their growth value, and they are being judged now at the moment because it's bad news in the market. They're moving all their investments from high management fees assets into low management fees assets, and that's impacting their cash flows. It's impacting their revenue. It's impacting their bottom line. But if you actually look at their AUM growth, and I have a chart there that you can see in front of you. you can see that they had really strong growth in 2019, 2020, 2021. So they're being judged off a really high base. But if you were to normalize those to the growth rates that you see from 2008 to 2016 and apply that from 2016 to 2023, that growth rate is actually quite steady and decent.
Yeah.
Yes,
Yeah.
yes.
Yeah. Yeah.
Even with the decline at the moment. So I'm not one bit worried over these. I'm actually glad there's a little bit of bearish sentiment in these because it drives that share price down. And look, we were saying TROW price under 100 is a good deal. It still is a good deal. They're yielding at the moment 5.52%. How low can they go? I don't know. But like you said, the
They can
balance
go to
sheet,
zero in the end. Yeah.
they can all go to zero, but realistically, but the balance sheet, I think, is what set these guys apart. And I think management have shown that they're well capable of navigating this type of market. So let's see. I think probably the next 2, 3, even 4 quarters, we might see more of the same. And we'll see. But I'm not worried about it. There's bearish sentiment. They've had a couple of hard quarters, but they're coming, in my opinion, from a high base.
And this is a company that also doesn't need to cut the dividend. The only because the dividend is safe. The only reason why I would see them considering this, if they would say, like, guys, we throw our whole business model overboard and we start something totally new with low cost Vanguard kind of style ETFs only. Yeah, then it becomes a different point. But that would be stupid. That would be so stupid, and I don't see them doing that. So, yeah. That's the interesting thing now about in the stock market, right? Who has the balls to buy these kinds of things? If you look at the stock price, if you don't look at the stock price and forget about it, if you only look at stock price of today and do your analysis, then probably it looks much more positive.
I think what you just demonstrated pretty much is that you have to zoom out. Because in a zoomed in perspective, it looks pretty bad, but when you zoom out, it actually looks quite okay. And like you said, everybody loves quoting "Boy, when there's blood on the streets." Everybody, but who has the cojones to do it? That's the question.
Yeah, or when you liked it at 130, you must love it at 90. Yeah.
yeah.
Here we are. Well, I can tell you, sometimes love disappoints. It sounds nice when you have like some butterflies in your tummy, but later on, you know what it really means if you're 15 years married, 2 kids there.
So look, let's sum it up. I think bad quarter, similar to the rest of the year, but overall, I think the company is still in good shape. So
definitely. Well, then the second one that also Hans asked about, that, right? One of our followers, is about Texas Instruments, and this is also again a really interesting stock to talk about. So if you look at their how is it? The revenue declined with 14%. We all know what the chip industry is currently facing, right? The headwinds, the industries generally, like, look, I think we all know this. We work also in companies. We know that most of the companies all have cost-cutting exercises and programs, that's happening now to fight inflation. So if you're then a company like Texas Instruments, who's like early on in the value chain, for other companies, and it's consumer led to some extent as well, then it's no surprise that revenue is going down. So 14%, and the earnings per share was 185 this quarter compared to 247 last quarter. Now, from earnings per share, we're all good here, right? Also nicely covering the dividend. But then you look at cash generation, and you see the cash flow from operations, 6.5 billion compared to 9 billion last year. There's 28% decline. A capital expenditure of almost 5 billion, which gives us the free cash flow of 1.6 billion. On the other end, the dividends, and here it comes, that they paid in third quarter were 4.5 billion. So they lost 3 billion that they had to borrow money to fund the dividend this time. And they also bought back shares for 1 billion. So that's a 4 billion already. So they have been leveraging up a little bit. At the same time, what you see in the balance sheet, of course, the capital expenditures went straight to the asset side of the balance sheet because it ends up in the plant and property and equipment side. But I would say the balance sheet gets a little bit weaker, but let's not be mistaken, they have a very strong balance sheet as well. Now, what is interesting, right? some people are surprised about this, that the dividends are not covered. But we have spoken about this before, about Texas Instruments, when we did our breakdown episode about them. So we can also link that episode in the description of this podcast, because we know that in the next 3 years, they're spending about $3.5 billion annually on investments. And of course, the CHIPS Act is now there in America. So they get some really attractive deals here when it comes to building future manufacturing, because effectively America wants to bring back their manufacturer onshore. Yeah. So this should not come as a surprise. What was a little bit of a surprise to me is that they said like $3.5 billion on average per year, and we are talking here about $4.5 billion. Well, $1 billion miss on an estimate of capex is a lot. Yeah, and they can tell me they're bringing it a bit forward, but we heard this story also in Intel. Yeah, the good thing here is, like, if you compare Intel with Texas Instruments, first of all, Intel is mainly losing revenue, not because of an industry weakness, but because of their competitors eating their lunch. Yeah, that's the biggest reason. Second one, if you think about Texas Instruments as such, let's say, I mean, they have the balance sheet place here, the balance sheet. So I don't see them cutting the dividend at all. And also for that reason, yeah, I bought some more Texas Instruments when it dropped at 240, because I know what the story is. In my opinion, Texas Instruments has probably after Satya Nadella, probably the best management of all my portfolio holdings. They're so clear in their communication. Their reports are really easy to read. They talk about, they know that they follow my philosophy, or it's just a match, let's say, that free cash flow is king. So everything that they are doing, saying they are doing, share price went down because I think if you look at Wall Street, they just look at an earnings expectation. If it is a bit lower, they punish any stock. Yeah, so here it's again like, are there long-term opportunities now? To make a very long story short, I think you don't need to be in a hurry with investing in Texas Instruments. They are still investing a lot over at least in 2024 and 2025, and then some of the plants will come online. Just expect this, that there will be still some dips, and you don't need to hurry. That's my expectation.
Yeah, I think I have to agree with you. I circle back to the discussion we had on ASML maybe the week before last, 2 weeks ago, and if we remember what they reported, that they are reaching the bottom of the cycle, and they expect that to take around 12 months or so, and then we might start seeing that. And I was also interested to hear then how the likes of Texas Instruments would do, or Intel. I missed Intel's earnings, but I'm just curious to see what they're reporting. Are they going against what ASML are saying, or are they going along with that narrative? And it seems like Texas Instruments are going along with the same narrative. I have to say, I'm not entirely enthused that they are supporting their dividends through debt. It's not something that I particularly like.
Me neither.
As you said, this is a bet on management, pure and simple. Do you trust management know what they're doing here and taking short-term pain? I believe so too. As you said, they're very clear in their communication, and I don't see that changing. And if it does, then we could be in big trouble. So I think probably this year or next year you might see the same trend happening, and it will create, in my opinion, better price point for Texas Instruments. And this is what we've been asking for. You need to get these types of companies at below fair value prices. You need some short-term pain. You need something to trigger that, and this could be that trigger. But like you said, this is the type of company, or this type of scenario is something you really have to have done your own homework on. You need to have conviction in this, because if we're wrong, and we could be, you could be in a whole world of pain here. Particularly, they could easily cut that dividend in half if they can't afford it. So you really need to have conviction in times like this for companies like this. But like you, I don't think there's, like Sanofi as well, I don't think there's any rush in the minute. Even if they get a good quarter next quarter, I don't think their share price is going to rocket up based on what we've seen over the last two quarters.
Yeah.
But all in all, look, it's such an easy report, and as I said, I trust management at this point. I have no reason not to trust them, but I'm not naive or stupid either. So it's something that I need to keep one eye firmly on and see how they go. But yeah, nice one.
Good.
So we had another suggestion by Hans again. He's this is the third company, and that is LYB, ticker symbol LYB, that is, and that's the chemical company. It's a company that I don't really pay too much attention to because I know they had troubles in the past with the dividend and even went bankrupt. And I find it hard, even though since then they've performed stellar, and you spoke about it and we spoke about it as well on the show. But just to give you some of the headlines, their net income was 0.7 billion, which was 2.29 per diluted share. And this is actually a 30% increase from a year ago when it was at 175. They have seemed to decline across most areas in terms of revenues. They've talked about softening demand, which is going to continue through to next year. There's also some higher prices as well. So their margins are coming under a little bit of pressure. They returned 448 million to shareholders through dividends and share repurchases. And they've got about 1.7 billion cash on hand as well. So it looks to me like they did okay this quarter, but it looks like they're setting yourself up for next year, saying demand is weakening. We're going to come into a period because it is a cyclical business, and it looks like they're going to start coming under a bit of pressure over the next year or two.
Yeah. Very, very interesting. I just don't know enough about this company to say anything relevant.
Yeah, it's hard. I think it's a hard industry to analyze. There's so much at stake in these chemicals. You know, macroeconomics can play a huge thing, and then also you have your raw materials. The prices of those fluctuate as well. So there's a lot to consider with a company like that. I took them off my. I remember I was researching them, and once I saw they went bankrupt before and the dividend cut, it's kind of hard to trust management then. And we're coming into times now where it's getting quite difficult, and now we'll see what management are made of. Can they sustain through a bad cycle? And that's what we can judge these guys on. But yeah.
Well, then the next company I would like to talk about, we need to talk really some iconic European company now, and this is Unilever. Yes, we still talk about Unilever from time to time. It has been quiet at the podcast, but hey, listen up. Simply said, they made 15.2 billion in sales in the last quarter. Generally, let's say organic growth was 5.2%, but they had an 8% overall impact from currency headwinds. So that's why actually, if you compare it with 2022 for this quarter, they had a almost 4% decline. Their best growth was in the personal care, 3.6 billion in sales. Generally, over the whole year, this business unit has been growing the best, with almost about 10% year to date. So all in all, I would say, the currency impact is really hurting the company, which is a pity. Also, the ice cream business didn't do so well compared to last year. A bit of a mixed bag. The company also got punished for it. And, this is very interesting because, I'm a Dutch person, right? And Dutch people are known for their directness. So it's so funny to read this on the first page on a quarterly report. What they are saying here, what the CEO is saying here, Heinz Schumacher, despite these strengths, our performance in recent years has not matched our potential. The quality of our growth, productivity, and returns have all under-delivered. We should now really put all the Ellen Yopi openings here. Like, we had an awesome quarter. I mean, he didn't use the term awesome, but all these like bullshit headlines that he was giving us and tapping himself on the chest, like, look how good I am as a CEO. And then he blew it almost up with the GSK acquisition. And really, if they would have done that, this company would be in dark red debt at the moment. So he almost killed the company, right? So we also got a question here from Herman van Niekerk, and he asks us also about the new strategy that they're introducing. Now, what I like in general is this strategy is really easy. They want to focus on their first 30 power brands. Effectively, they want to milk them out to the bone. They just want to milk it.
Yeah.
I think it's clever to do that. I think focus is needed. I hope it also puts a little bit less emphasis on ESG, because we know Unilever in this case, right? They are very, very altruistic. And of course they should, in my opinion, stay a leader in ESG because it's important. But they should not forget about the fact that they are playing in the capitalistic market. So I'm really happy with this, that they're doing this focus. The guy, the Heinz Schumacher, seems determined to make something out of his era. I hope he gets it. I'm a bit on the sidelines. I mean, I have a large position in Unilever. The dividend streak has ended because that was a question of them, that they lose the dividend streak. Well, effectively, if you look at how we treat the European Noble 30, then not, because they had a flat dividend, but they have not been growing their dividend already last year compared to the year before. So we're still getting €1.71 per shares. But yeah, look, you know what it is with this company at the moment. I see the good intention of the CEO. I like his statements, but I wonder if this company is easy to turn around or to find a path of growth. I think there's more to this, and it might be also a little bit of culture that needs to change there.
Yeah. Look, I'm reading here the priorities, the 3 priorities they have, and this new strategy that they have. But is it a new strategy? I don't really know. Focus on the 30 power brands that they already have that generates a lot of their growth. So what is the focus? How are they going to milk even more out of that? I don't really have a real sense of what this. It's easy to say faster growth, and it's easy to say focus on these, but how are you doing that? They're going to scale innovation. I don't know. To me, it just sounds like fluff. It's just words on a paper at the moment. So I'm not really too enthused about that. I do like the directness, and I do like that the CEOs come out and said, "Look, we've been pretty poor over the last year. Let's not hide it. We're not performing as well as we should be." But look, everybody knew that. That's why he's in the job in the first place. So look, let's see. It's still early days for him. If you look at the numbers, yes, currency has hit them hard, and we have to put our hands up. We bashed Nestle on this show, was it last week or the week before? And I got a comment, and rightly so, saying, have we thought about the impact of currency, which has roughly around a 25 to 30% impact over the last 8 or 9 years based on the strong Swiss dollar, Swiss franc. And I put my hands up and said no. And we can see here, there's also a huge impact from currency. But if you take currency out of it, what I do like to see is actually the volume decline was relatively flat compared to what they're increasing their prices. So you can see they're trying to offset inflation, the premium brands, remember, and people are still buying their stuff. So that, I think that's good to see. But look, I will have a look. I need to read a little bit more into what the CEO is offering, what he's saying. There's only a little snippet of it here just to see how I feel about it. But I want to keep a close eye on over the next quarter, 2 quarters, and see what they're actually delivering. What is their plan? How are they focusing on those 30 brands, and how are they going to actually drive more growth and sales in those brands? So let's see. Talk is cheap. Actions. We want to see actions.
We want to see actions. We're desperate as investors in Unilever to see actions.
Yes. Okay. There was another request that came in from a company that I know nothing about. It was suggested by David. And this is a Swedish company called Sagax, Sagax. So I knew nothing about the company. So just to give you a bit of a background, it's an investment company, so like a real estate investment trust, that specializes in commercial properties, particularly warehouses and industrial property. What I really like, if you go onto their investor relations, go to our About Us. Everything is really clear, straightforward. They give you About Us, our investment strategy, what we're looking for, what we're doing, and it's almost Texas Instrument like. It's very clear. They give you their strategy, their goals the whole way through, and I really like that. The core principles involve around long-term perspective, and they stay away from what they say anything considered high risk. They've got 811 properties across Sweden, Finland, France, Netherlands, Spain, Germany, and Denmark. So they're pretty much spread all throughout Europe. They're listed as a large cap on the Nasdaq, on the Stockholm Stock Exchange. So honestly, when I was reading that, I was quite impressed. The numbers this quarter also looked quite strong. The revenue increased 19%. The profit from property management increased 12%. Their profit after tax was 634 million. Their cash flow operating activities before changes rose about 40%. And they have a Baa2 outlook credit rating with Moody's. So it looked quite popular. Now, I'm not basing that off any other year because I haven't looked into them, but it does look quite strong based on this quarter. What I did like was the average lease term seems to be 11.7 years, and they have unilateral right to extend these lease with almost all their tenants up to about 30 years. The occupancy rate currently stands at 96%, which is quite good. I think Sweden is the hardest hit, and we know how hard that demographic has been hit at the moment. So I'm not too worried about that. I was looking at their financial policy. So they have a debt. The policy is to have no more than a debt ratio of 50%. They're consistently under 50% over the last 10 years. They want an interest coverage rate exceeding 3. They're currently sitting at about 6.4. And the balance sheet looks quite good. They do have some lease terms. I'd say about a quarter of their lease terms expiring over the next 18 months. So it'll be interesting to see what happens there. But look, overall, it looks like a decent company, and maybe one worth doing a little bit of a deep dive in, getting to know the company. But like I said, I did like how they presented everything. Everything was clear. Their actual report was really good. It was actually long. I didn't have enough time to ingest it all. But as a first glance and a first run through the company, it looks like a decent company.
And then is my understanding correct that it is a 1.4% dividend yield?
Yeah, I actually didn't look at the dividend yield. I didn't look at that. It could possibly be. Now, what confused me when I was reading through, they seem to have Class A, B, C, and D shares, and the dividend structure seemed different for each of them, and I didn't quite grasp that. I did try look at the way that was, but I didn't have enough time. So that did confuse me. And it needs a little bit more, I would say, research for me to understand that. But okay. It'd be strange for a REIT to be that low, I would imagine.
Yeah, I think they only want to pay a third out of their earnings or something like that. So they have a relatively low dividend policy, and therefore, is it really a REIT or is it just a real estate company?
Yeah, it's not a REIT. It's not a REIT.
Yeah.
It's
okay.
Yeah.
Good.
Yeah.
So that explains.
But when I was looking at so they give like their strategy, they give all that. There was no mention of dividend in any of that. So I don't know how committed are. Maybe it's not a priority for them, but they seem very clear on everything else. So when a company doesn't say that, it probably tells you more about where their priorities lie. But still, it looks like an interesting company to all the same.
Yeah. Hey, then the last company that we discuss here as part of the earnings is Assa Abloy, another Swedish one, the world's biggest locksmith, right? And they have nice products that we can try for lock picking as well. Hey, look, their sales increased by 16%, my friend, 16%. However, there's a catch to it because the organic growth was only 1%. So flat growth, not bad for what when we are seeing an earnings recession at the moment, right? With due to inflation here. But of course, they have been doing big acquisitions, and it's anyway a company that's continually acquiring stocks. So that explains the delta. Generally speaking, I like this company a lot. Yeah, and I really would love to own some of this. But hey, they had the earnings per share of 3.31. It's an iconic European dividend aristocrat. So, I really want to keep this short, but I just want to highlight it that I'm kind of in love with this company. And if we talk about management, what I really like is if you go to their earnings release, they don't beat around the bush. Yeah, they just say straight away, like, guys, this is organic. This is due to acquisition. We know that debt went quite up because of the acquisition. Debt is still healthy for this company. But this is also a nice thing about this company, right? It can buy small companies and then use their worldwide distribution network, the scale, to really boost earnings here over time. So, yeah.
Do you know what? This is the type of company that, in my opinion, deserves for you to write a little deep dive about them. I think they're a perfect candidate for it.
Well, maybe I should then for the next newsletter.
I honestly think you should. It's one of those companies that you always talk about. You can tell your affinity to them. Somebody actually wrote to us and said, I think they've invested in this company based on everything we've said about them before. So I think it does, in my opinion.
Okay, let's consider that done then. I'll write about them in the next newsletter.
Nice. Okay, so that concludes the earnings. We could have done a lot more, but we have so many questions. I think we just kind of tried to cap it at what we had. And look, as we say, keep the suggestions coming. We would definitely prioritize those over anything else. So thanks to everyone who suggested companies today. But now let's roll on to these questions and we'll see how many we can actually get through. And the first one is from Frank, and Frank is a Scouser, which he hopefully thinks it will earn him some cred with me. And that just depends. Are you a red or a blue? I'm going to assume you're a red, and yes, I absolutely love Scousers. It's like my home away from home. But look,
what is it? A Scouser?
Anyone from Liverpool. So if you're from Liverpool, you're known as a Scouser.
Okay, I see.
I won't do him any injustice by trying to do the accent, but yeah, if you're from Liverpool, you're basically a Scouser. So Frank has asked us, he's curious as to our thoughts on Lockheed Martin and their recent numbers. He's considering buying a couple of shares. It's a total sin stock, but they had an 8% jump recently, considering the situation that's going on at the moment. Is it a bit pricey, or should he wait to buy them? So look, I think Lockheed, as you said, it is a sin stock. Not everybody likes to invest in them, but they are involved heavily with the US government, I believe. They have lots of contracts there. So you can kind of predict a lot of their cash flows, and then particularly then when there's a little bit of conflict, which you're starting to see regrettably more and more over the last couple of years, they do get a little bit of a jump in their price. And to be fair to them, when they do, they seem to reward shareholders. I don't know too much about their numbers. I haven't looked into them. I do remember that they dropped below 300 or 250 at one point, and I bought them and I sold them then when they went back up. But look, I don't think there's an issue with investing that type of company. You just got to know what you're investing in. But in terms of dividend history, it's quite good. They have it's still a decent yield. They seem committed to that dividend as well. And like I said, any troubles, they will seem to benefit. So they're probably a long-term hold as well. So that's my quick 2 cents on it. Alexandros has asked us, what is your earnings surprise of the week?
Well, it has to be Intel, right? Usually it goes 10% down lately over the last few years, but now it went probably 10% up. But honestly, I was surprised about this. I thought, like, when you read the news all the time and you see these things around Texas Instruments and all these companies, you hear ASML talking, then you think like, well, they should. I worry about Intel. And actually, so their third quarter revenue was 14.2 billion, down 8% year over year, but everyone was expecting more, so this was good. So they actually exceeded their own high end of the guidance. And effectively what they've been doing is they've been, and we know that they've been, just cost cutting, turning around every penny. Also, we know from the last time the accounting last quarter what they did, shuffling a bit with this with the amortization rates and such. But generally speaking, good numbers. I expected less this quarter. And the company is also in a really difficult situation at the moment because they're heavily investing, but they're at the same time losing market share, right? Their new products are coming online and such slowly, but although they get good reviews when I read it, I don't see it necessarily back in the sales as that it saves the company or that the turnaround is already starting in the revenue. So we still have a while to go here with Intel. The turnaround story, right? Not the dividend growth stock.
Is Pat still laser focused? I can see the keyword of artificial intelligence popping up on there.
Oh, maybe that's why it's up. But look, I follow Pat Gelsinger on Twitter, and every weekend he's praying to the Lord and quoting Bible verses. And I hope he will also pray for good earnings. And maybe good technology and maybe talent that will come working there. And yeah, would you work for a company where your CEO is all the time quoting Bible verses? I mean, I wouldn't make it my decision, but I prefer my CEO to stay away from that kind of stuff on Twitter.
Yeah, it's not a good look. Honestly, it wouldn't stop me from working in the company if my direct boss and my direct involvement didn't have anything to do with that.
Yeah, exactly. Yeah.
But honestly, I'd be thinking my CEO is a wacko, so I'd be quite on edge. I prefer to stay away from that. But then I won't say who the CEO of my company is, but if you follow him on social media, he lives a different kind of life. He's definitely not how would you say, praying to God. Probably more of a party lifestyle, I would say, which is also not great.
Nice one.
But I leave it there. Josh has asked us, what should a new dividend investor know about tobacco stocks in general?
Well, Josh, first of all, they produce unhealthy products, and you might think like, duh, why are you answering that? Of course, but what is important here is that there is a lot of attention to ESG, which stands for environment, social, and as a governance, something like that, which effectively means that large pension funds and such don't want to have tobacco stocks. So if you think, for instance, about British American Tobacco trading at a below 10 price to earnings, you might think like, hey, this is cheap. And you might think like, because the average stock market is historically trading at a 15 PE. Well, don't hold your breath for it ever to get there in the upcoming 2-3 years. This, as long as we have this whole ESG movement and tobacco is considered bad, there will be a small group of investors that is interested in these kinds of stocks. So I think this is, in my opinion, the most important to know, because many people sometimes make the mistakes by using the same valuation multiples as for Johnson & Johnson on the tobacco stock in their expectations, and that doesn't make sense. Generally speaking, maybe besides it, many of those companies are trying to go into vaping, or at least trying to make more profit out of it. We have seen from the latest results from British American Tobacco that they are really growing hard there, but it's still not entirely profitable. So in the end, the traditional tobacco stick is still the best, most profitable product of such a company. It's in general decline, but the price hikes allow them to mitigate that. And that's effectively what is happening with tobacco stocks.
Yeah. And the issue is that, like you said, the multiples are falling hard, their share price is falling hard, you're getting juicy dividend yield because of that. But is it a falling knife? Are you going to catch a falling knife? Because they just keep dropping and dropping and dropping. And you touched on it. Companies are trying to move into new categories, new areas, and ultimately the winners will be whoever can capitalize on those markets and grow those the fastest. They're still quite young. So let's see, but at the moment there's still plenty of people who smoke. You got emerging markets. There's always going to be people who like to indulge in unhealthy habits. So I don't think they'll go out of business anytime soon. But like you said, if you're looking for total returns, tobacco stocks might not give you the best
Yeah.
total returns.
And what's so funny is, right, some of those employees, they truly think they work in the IT industry because they call it inhalation technology stocks. I think they want to call it like that, so that Katie Wood would put it in their ARK investment product or something like that, and hope that it goes to the moon.
Well, looking at the share price, she probably did, because anything she's touched has gone to the floor. So
It's vaped away, went up in smoke.
It's vaped away. Yeah, very good. Yeah. So look, Josh, I hope that helps a little bit. It's not that complex of a market, I must say. There's plenty of research out there. So just do a little bit of reading. A declining market, really unhealthy for you, pays lots of good dividends due to cash flow. I think that's all you need to know.
Yeah, I would say, like, own them, don't smoke it. Yeah?
Yes. Oh, 100%.
Yeah.
Marcin has asked us, would you consider investing in stocks from countries from Central Eastern Europe, like Poland, if they have been paying dividends only for a few years, but have good future prospects and are attractively priced?
Well, I own Ambra from Poland. Generally speaking, I'm not so interested in companies from Central and Eastern Europe, simply for the fact that I want to invest in global players. I don't want to have a single country risk too much. I have a few in my portfolio, but those are more exceptions than the rule. I'm not so much into the tropical kind of investments. Let's call it like that. And for me, for instance, investing in stocks in Poland, you really need to understand the market. It's not the same as in the Netherlands or the global markets. It's different. I'm not saying it's better or worse. I'm sure there are really good companies in between there. But for instance, I was talking with a colleague the other day about Dino. Dino is a very popular supermarket chain, and I live here in Poland. And honestly, I wouldn't know where they are, but then I know they are probably more in the villages outside of the city. I live in the city or near the city, so they are not around here. So it is just hard to familiarize with those companies sometimes. But Ambra, I like their products. They sell liquor and wines and spirits and such. So.
Yeah, the key for me in that sentence is if they have been paying dividends only for a few years. It doesn't mention growing dividends, and I think we spoke before. We have a distinct strategy where we rely on growing dividends and not just paying dividends. So it would depend. And like you said, I'm even further away from Central and Eastern Europe. I couldn't be any further in terms of where I live. So it's hard for me to grasp.
Okay, but let's do it. Let's do this mind game. Imagine a consumer staple in Poland, mostly produces or sells products for the Polish market, maybe a little bit in Czechia, let's say. A 1 billion market cap, 15 years of dividend growth, 6-7% on average. Would you be interested in such thing?
I'd have no issue in investing in a company like that, but I don't know any companies like that.
No, me neither, but yeah.
But actually, Marcin looks like
Marcin
looks like someone who obviously is knowledgeable about that area. And we have lots of listeners from Central and Eastern Europe, and maybe if he's interested, he could come on and talk to us about these types of companies, their demographics, what they mean. No, maybe a little bit of a discussion on that. So if you're up for it, just contact us. I'd love to actually discuss that, because it's an area that we don't talk about a lot. But we know from the questions we've got a lot of people from that area, so I think it would be quite an interesting topic. So reach out to us if you're up for it, and we can definitely arrange that. Marek has asked us, did I pronounce that one right? What's your daily dividend? So he mean all your dividends from the year divided by 365. We know you don't disclose your figures, so you're not going to get that answer. Mine is roughly around just over 11 euro a day. That's crazy, actually. 11 euro a day. I can buy 2 cups of coffee a day for my dividends.
And what do you pay for lunch?
For lunch, well, I could definitely buy lunch every day as well.
Nice. So if your lunch paid forever.
I have my lunch paid for.
So you will not die from hunger.
I can get lunch and coffee every single day. So that's
Yeah.
nice.
So you're meeting almost the bottom of the Maslow pyramid, right? Which is about food and sex. So if the sex is also served at home, then you have your primary needs covered in life, and that means you live a rich life already.
All for just €11 a day.
Oh, boys, people should see you how much you are turning a red face now.
I was not expecting that, I have to say, especially when you mentioned Maslow's theory. Let's move on to Lynx's question. It's quite a long question, but basically he's saying that the boomer generation is coming up to retirement, and this might have a significant impact on investments, particularly through pension funds, and lead to substantial stock market devaluations due to mass selling. Could the retirement timing differences between boomers gradually sell shares and their peers cause problems for both individuals and pension funds? Or on the flip side, will it create some opportunities where you can buy?
Oh, I find this so hard to predict. I think he is onto something with this. But, I bought Omega Healthcare Investors at the time because I was expecting all those boomers to start dying as well and needing their services for the last week of their lives. But, it hasn't played out as I was thinking. I think a lot of these hypotheses around the boomer generation are not well playing out still so far. You hear this often around certain companies, certain industries. So, yeah, I think there's a possibility here. Yes, of course, when those people die, their 401ks or whatever they have, they will probably be sold because probably their kids will want to have the cash and buy something for it. So the question is like, how does the transfer of wealth go? We know that the government is in between there when it comes to inheritance tax in many countries. So I expect mainly the governments to be the biggest beneficiary of it. And yeah, it will mean selling. But I always had the feeling that the stock market is propped because of low interest rates and because of index fund investing due to, lots of money saved by consumers. So it's an interesting theory, but I don't know.
Yeah. So it's such a difficult question to answer, but in theory, what he says makes a lot of sense. You would think that if boomers are taking out their pension funds in masses, it's going to have some sort of effect.
Yeah.
But I mean, I don't know. It's
So there's an awesome dividend stock, but I forgot the name. I can look it up, but they effectively their business is about selling tombstones and everything from graveyards in America, and that could be a really interesting one. If you expect the boomer generation to die in America, well, at least the kids that will inherit those portfolios will be able to buy a place at the graveyard and give them a nice stone. I can look up the company, and if I find it, then I'll put the ticker also in the description of this video. But that might also be a nice one, right? If you expect a lot of death.
Yeah, it depends what you mean by nice, but
yeah, sorry for that. I know what you mean.
I get what you mean. Yeah, if you're worried about that, it makes sense in investing in those type of companies. I'm trying to Google the company quickly. I can't find it too easily. So
yeah, I did once an article about at the time of Halloween with 3 ultimate Halloween stocks on my blog, and I know I put the ticker in there, the company in there, because I discussed it there.
Okay, awesome. Adrian has asked us, you guys talk about tier 1 high quality stocks. What is the list of these? He's asked us for names of 5 to 10 high conviction, high quality business that look fairly valued right now.
Okay, so my tier 1, and I will pick a few out that are in there. Texas Instruments, Johnson & Johnson, Ahold Delhaize, L'Oreal, and Realty Income. Those are in my tier 1. I've got also Microsoft there, Apple, but I think they're a bit overvalued. Munich Re as well, Pepsi as well. So those are my tier 1.
Yeah, looking at the fairly valued now is quite tough. In terms of tier one stocks, you're looking at companies like, to me, it's companies like ASML, Apple, L'Oreal, Nike, Microsoft. Even someone like he or she might get in there, and Ahold Delhaize. ADP might scrape in there, but yeah, I don't know about fair value. I haven't looked at valuations, but I think they're all quite decent stocks to own. PepsiCo is also in yours, I think, is it?
Yeah.
PepsiCo. Dividend Gardener has asked us, are you, as a shareholder of Cibus, also interested in the London Stock Exchange listed company Supermarket Income REIT? It has an all-right debt structure, high yield, and low dividend growth policy.
Yes, I'm interested, but on the other side, not. First of all, I'm not familiar with them. And if I wouldn't own already a lot of these kinds of real estate companies, I might be interested. But look, I own Realty Income with such a profile, Cibus, as he says, Agree Realty with such a profile, and Defama, the German one. So it is becoming a little bit too much allocation towards supermarket chains. Although I do believe that this is an industry that will not go away anytime. But, from a risk point of view, maybe at a certain moment everyone starts buying online, and we need more distribution centers than this. I don't see that happening anytime soon, but I do want to avoid having too much allocation in my portfolio to single industry like that here. So that's why for now I'm not looking at other stocks anymore. But it sounds interesting, and maybe one that we can one time look into for just in general for the listeners.
Yeah, I've heard a lot about this company. It's actually well regarded, particularly within the UK. I'm invested in them indirectly. I've spoke of investment trusts, and one of the companies I invest in is Murray International Trust, and they do have some exposure to that company. I've listened to the portfolio manager of Murray International, and he speaks quite highly about Supermarket Income REIT and the opportunities and the growth that they have. So it does honestly seem like it would be a good investment. But as I said, I'm invested directly, and I don't need to go invest directly in them. Paul has asked us, which of your stocks are you seeing a drop in and are getting worried about? For me, I think I spoke about it last week, is Walgreens. I think I just don't see good news. I don't see where the growth's coming from. It looks like the dividend will come under pressure. They just announced the dividend, I think, today or yesterday. It's the 6th quarter in a row where it's been the same. We know what that generally means. They're under pressure. So I think a cut is going to happen within the next year with these guys. So it's definitely one that I'm worried about. They cut the dividend, and their share price is probably, I wouldn't say half, but close to half from when I bought them. So it's not looking too good.
Yeah. So I mentioned TROW before, more from a price, but generally I'm not worried about them. But if there's one company where I'm not so happy with in general, is Viatris at the moment, because management has been changing the business so much over the last year, 1.5 years, that it feels like I'm not invested anymore in the same business as when I stepped into it. So Viatris is one of those companies in my mind that I feel like, do I still want to own this company after selling biosimilars? It was one, but then some of these other stuff that they are doing as well. So it's a company, but that's why it's a small position in my portfolio as well. So probably I will just let it go through its transformation. But it's not, I don't like it that they changed the company so much, and it was every time a little bit of a surprise.
Yeah, the biosimilars caught I think everybody off guard. That was the best performing part of their business, and we know they have a high level of debt that are, in fairness, trying to reduce at a rapid rate, but the dividend is not a priority. So now you have a company who's changed their business profile that doesn't prioritize the dividend. Do they fit in our portfolio? The problem is they actually still seem too cheap. That's the problem.
Yes, that's the issue.
Yeah. Alexandros has asked us, Bristol Myers, BMY, good value territory right now.
Yeah, I spoke briefly about them. I don't want to say positive yet because I haven't looked at the company for 6-7 months. But if it is with the knowledge from 6-7 months ago, I would have been probably buying now. But you know how I am. I always do my homework. Specifically, if I haven't looked at the company for half a year or more, I want to know, is it still the same company?
We have a question from JC. He's asked us what we think about UPS and ADP, automatic data processing.
So for UPS, I think it can still go much lower if we see a consumer recession. Also, they hiked the dividend at the time with 50%. I was not too happy with that. I thought they were a little bit too much ahead of the curve with this. They could have just stuck to the historical dividend growth rate. But look, if I look at automatic data processing, that's really a nice company, right? So if I look at our dashboard quickly, I see a really nice dividend growth history, which is amazing. So that's already very, very nice. And if I then look at their financials, they're making about 8.8 in free cash flow per share now, or 8.2 in earnings per share. Their free cash flow generally is far above the... I said over the last 12 months was far above the dividends they paid and the stock repurchases. They're generally, if you look at everything, their share buybacks over the last 8 years also, they reduced with, what is it, 15-17%.
Yeah.
So every year buying like 1.2 to 1.5% back in shares, plus the, what is the 2% yield or something like that at the moment?
2.2 and 2.3 nearly.
Yeah, I mean, high quality business in my opinion. All the figures look good, so I like that one a lot, and I will put it on the radar. This is typically the company that I could start nibbling in, maybe at 2.5 or 2.75, something like that.
Yeah. Fun fact: it was one of the first companies I had bought back. Not one of maybe third or fourth company I bought back in the day, and you know the way you make that mistake where you sell companies because you think they're overvalued. Yeah, this was one of these guys, and I think they nearly doubled in price since that time. But yeah, really strong history. 48 years of no dividend cuts. 5-year CAGR of about 12%. As you said, payout ratios 50 to 60%. Strong cash flow, strong dividends. Yeah, there's a lot to like about this company. Definitely should be on everyone's watch list, in my opinion. El Kuba has asked us our thoughts about GSK. We get asked about GSK quite a bit, actually. It's quite a popular company out there, but they've never been on my radar because it's like Vodafone. It's a strong name in Britain, but they've cut their dividends, so not reliable.
Yeah. I don't like the company. Simple like that.
Yeah. Marcia, how do you pronounce it? Say it right for me.
Marcin.
Sorry, my Irish dialect. It's hard to pronounce names properly. But from a dividend perspective, what is better now, TROW price or BlackRock?
So I'm not so much interested in BlackRock, so I would always answer TROW price.
Yeah, it's probably some bias there. I don't know. I haven't looked into BlackRock in quite a bit, but I think having a little bit of both is probably not a bad idea. BlackRock are similar to TROW, I believe. I don't know what their balance sheet is like. As I said, I haven't looked at them in quite a while, so it's hard to give an honest answer. Tuk Unbo has asked us, what are your thoughts on Archer-Daniels-Midlands, ADM? So again, I think they're a competitor of a company that I write about called Ingredion. So they're in the food industry. If you look at their balance sheet, it looks like they have quite a strong balance sheet. To be fair, they got very little debt. Their equity is roughly, I can't see the figures there, but 20 billion. Their cash flow has been all over the place over the last few years, but I think that's been like that for almost all that industry. They do have a good history in terms of dividends and increasing dividends, and they do have some strong actually free cash flow growth over the last couple of years. So yeah, look, it's one of those cyclical businesses I follow Ingredion a little bit better, and I know corn prices and stuff is really starting to hit them hard. I'm sure it's probably similar here. Yeah, I think it's a company worth looking into. But maybe there might be a better price point for companies like this. I prefer to buy these type of companies at the bottom of a cycle, and not at the top. And if it's something like Ingredion, they would have done well over the last 2 to 3 years. And I'm sure their share price has reflected that. So I would wait for probably a better opportunity. But overall, I think it's a decent company and worth looking at. The next question is from Moyek.
Maciej
You're going to have to start saying the names.
Maciej. It's from Maciej. Yeah. We have a good Polish following here. I can see that.
We do, and I need to learn how to pronounce these names. What do you think of VICI's recent acquisition of Bolero and Canyon Ranch? So Bolero are basically bowling alleys. So they bought something like 38 different bowling alleys, which I thought was quite strange. I don't know how much of a return they get off bowling alleys, but I suppose when I was looking at it, they spent about 432 million on this. It's a 25-year lease back, so they're renting it back to Bolero, and they're going to stay in where they are, and they get roughly 31 million a year on that. So probably about a 12, 13, 14-year payback on that over a 25-year lease. So probably is not a bad investment for them. But what you got to remember, this is just 1% of VICI's rent roll. They've got 2 huge tenants in terms of Caesars and MGM, which I wrote about on the last article about VICI. Is it diversification? I don't think so. I think with VICI, they have a long-term plan in mind. They always look at something like this. They put their foot in the door. It's opened them up to 11 new states, but 7 of them don't have casinos. So they're probably getting their foot into these areas, getting to know the local governments and local mayors, and probably starting to build portfolios there. So it's probably a clever move from them. And for me, it's no harm in diversifying outside casinos either way, but it also gives them rights then. If Bolero sell any of their other portfolio properties, VICI get first pick at them as well. So they always seem quite good at picking up these types of deals. In terms of Canyon Ranch, they're like a wellness center. They're basically like a huge wellness center, and I think it kind of fits in well with VICI in terms of VICI tried to give people an experience. They call themselves an experiential real estate, and if you look at Canyon Ranch, they have the same type of philosophy. It's an experience, but a different kind of thing for wellness. I know there's a local one here. I'm not going to say the name. I'm not going to say who goes to it, but somebody close to me goes to these type of wellness, and it's amazing the amount of money that's spent, even in a small one. So I'm thinking if that happens in Ireland, in a small town in Ireland, it's probably tenfold over in America. So there's definitely a market there for that. But what they did is it's more of an investment. So they become a property, or they become an investor in this Canyon Ranch, and they're financing them. I think it's 150 million that they're investing in this type of company and helping them grow, and they make money back on that. And I think they also bought some businesses off Canyon Ranch as well, separately to this as well. So look, I think they're 2 actually okay deals, but we got to remember the amount of money we're looking at here is quite small in terms of their overall revenue and that. So I'm not too concerned. And they paid for Bolero in cash as well. So to me, it's not too bad of a deal. But I definitely don't think it's diversification, but I don't think they want too much, considering they don't even impact the rent at all. Okay. Mayek has also asked us about Alexandria Real Estate. He said he used the analysis from the VICI newsletter, and he just wants to share some facts. Funds from operations per share growth was 6% year on year. Dividend per share growth is 5% year on year. Dividend payout ratio is 55%. Occupancy ratio 93%. No debt maturities prior 2025. Debt to EBITDA 5.1 and an interest coverage of 8. Look like decent numbers, really, don't they?
This looks like a really good from the metrics, right? It looks really good, really solid. So I think Maciej, well done, by the way, first of all, on the homework. Really nice to see how people start to do this themselves and how we can learn from each other and influence each other. And I think, Maciej, now the question is like, start reading up a little bit about management, their business plan that they have, where do they see growth, what's their strategy. And if you're still convinced, well, you know what, then I would see no reason for stopping yourself and not buying it, right? It's all about building conviction. The numbers seem to be very solid.
Yeah, and look, the one thing I believe I fell short on in the VICI analysis is their tenant. Like, they're so, how would you say, they've got two customers or two tenants that have so much of their rent. You really need to do a separate deep dive analysis on both of those companies to make sure that they can continue to afford the rent. And then we know there's rent escalators in there, so can they continue to pay that if that happens? So I think you need to look at the tenants a little bit as well, just to make sure that they're okay and there's no other risk there. As I said, that's where I think I fell short on VICI, but overall, ARE it's a good starting point. I think it's definitely worth looking into a little bit more. Peter Caronson has asked us, what do you think Evolution AB could do with the huge amount of excess capital they are generating? Paying this year's dividend is barely making a bump, and acquisitions, which management have said, are not on the table.
Yeah, it makes also not a lot of sense to do acquisitions when you're in such a growth path, because then you will only get distracted, because this business is just growing with 20-25% annually. It's crazy. And look, I think they can save a little bit up for the future while they are growing so fast. Although now under 1,000 Swedish crowns, maybe they should start buying it back at a price to earnings of 19. 25% growth gives it even a PEC ratio of less than one of the Peter Lynch favorite metrics, where you look at the PE and the growth. I mean, they should probably just buy back shares if they have cash left from their free cash flow. I don't see anything else that they should do right now. I would love their dividend policy to be changed a little bit, not to distribute out 50% of profit. From my point of view, they should just say, like, you know, growing dividend, and of course, and maybe then not bump the dividend by 50 or 60% if you have so much growth, but just like by 10% if you had a good year. This is effectively what Microsoft is doing. Over time, of course, you make the yield lower, but for current investors, I think it brings stability, which is nice.
Good. Okay, I think we'll leave it at that. We still have around 8 or 9 questions that are still on the list, but what we'll do is we'll take them and maybe answer some of them next week. There's some companies in there I'm not 100% familiar in, so I'd like to give them enough time to look at them. But thanks a million for all the questions. I was not honestly expecting so many. So I hope we did them justice. As always, European DJI, thanks for your insights. And to our listeners, we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.